Obviously not used Zoom for this for a long time. So can you just let me know you can see me, hear me? Normal housekeeping shenanigans. Graham, you're alone. Everyone else can. So that's maybe a you thing. That might be a you thing. Just checking to see how I can just let people in instead of me keeping an eye on it. So bear with me a second. Yes, if you click, all good now, Graham, good stuff. You can't if you make the meeting secure. Okay, Kevin. Yeah, just trying the amount of options in Zoom to play around with this stuff is pretty mental. So this is recording, it'll download, we'll then put it on YouTube as unlisted, which then enables people who aren't English speaking to be able to translate it more easily too. So that'll happen after this. But also, it's nice to see the thread idea with adding the question. That saves us having to copy and paste the questions from Crowdcast and everything too, and people can see the questions asked, and obviously everything will get answered. So that's quite helpful as well. Doesn't look like there's anyone else to add so far. So a few bits and bobs to go through, as well as obviously your questions. I'll start with the account recap. It's been a few weeks since you've probably seen my accounts because Michael's done a few of these. I'm going to talk through, some other bits and bobs and context around things that maybe crop up in chats or where people are at. Bit about DarwinX, quick look at the POW Edge updates, talk about the one trade strategy stuff and where I'm at with that. Yeah, that's about all of that really. So I'm going to go to screen share. Share screen. Okay, you are sharing screen. That's always a good sign. So first things first, the AUD CAD account that's really low trade volume, but we're in 14% drawdown. These are the trades that are in the copy account that opened from the end of April. If you joined in June and we made 8 or 9% on the copy trader, you won't be in these trades. It's accounting for about 15% of the open drawdown right now, I think, on the copy trade account. It's just a bit annoying because they've been open for a while, and it's probably a little bit unlike how this normally just gets in and banks. I did have a VPS issue on this, and maybe if I hadn't have done that, it was in profit for a while as well. I think that might be why. But we're not seeing anything different to what I've seen already on this account. And what I mean by that is, yes, the hold time's longer, but I'm not in a new number of trades in terms of the sequence. Yeah, the sequence we're in, I've seen before. And that's just one of the things I would, some of these questions are in the Discord, but I'd look to, if something went rogue or different to what I'd seen over a period of time. Let's say I'm running something in the live market, or let's say I do a back test and the max open sequence might be 7 or 8. Let's say I go in the live market and it's kept at no more than 7 or 8 for 3-4 months. And all of a sudden I get a stack of 13, 14 trades. That might trigger me to either do two things. One, accept it and just see if it's an outlier and it might settle back down and continue. Or if you're tight on licenses, you might then choose to re-optimize that at the same time too. Because ultimately, when I look at, I'll get to it in a minute, but my gold account, that will explain and give a bit more context to that as well. Couple of littler accounts that I'm really pushing in terms of risk, and I'm going to share with you a concept and an idea that I stole from somebody else, but we can make it our own a little bit. in regards to live capital too, and how you might set up your accounts in a different way weekly. But I'll come back to that. But this just shows what's possible. I've got 13% drawdown, but it's made 69% in literally this period here. So I could get out, bank, go again. But we'll come back to that concept and what idea I might want to, what I'm going to share with you on that. Michael had a similar idea, and he's going to look at something too with smaller capital to scale and see how far you can get on a ladder by ladder basis. One of my Darwin X's, this is just in calibration at the moment. This is running a very similar strategy to what's also running on your copy trade, but a hedging and averaging style approach that I've been running for a long period of time here. This one's got a small multiplier on it, so I've started a lot smaller. I've added I've got a multiplier, but a max lot size at 0.5. Now, we've spoke a bit over this last week or so over risk-adjusted return. And it's really important for a few reasons that people understand that how drawdown and net profit gains and how to make, sorry, just admit someone in, how to fully understand stuff. So if I ran this for a month and my peak drawdown was 1.7 and I've made 1.7, then it's a risk-adjusted return of 1. Some people might go, hey, for that risk, I've only made that back. But if you're only looking at it for 2 weeks or 1 month or whatever in isolation, it doesn't mean anything. You've got to run that for a much longer period of time. So this, I think, has had a peak drawdown of 1.3%, and we're up 1.7. That was a big move on USD CHF that a lot of you have been caught out with. So that absorbed that within that percentage. So ultimately, that was quite a big move. So the chances of me getting another big move for a few weeks might be slimmer because I've just had one. But if I do, I know it can absorb it, and B, it's banked. So, over the pit, I fully expect this account, right, to make 3 to 5% a month based on what I've run in the live market. And that when that cumulatively carries on, if my peak drawdown stays between 2 and 3%, my risk-adjusted return is going to increase over a period of a year, right? So all I'm trying to explain there is it's important to A, understand that, and B, run your accounts for a period of time. You might run a back test and in that first week of live trading hit the maximal drawdown. It doesn't mean that isn't going to then continue to be profitable over a longer period of time. But you earn the right to see those results by being patient and letting these play out too. This one, not so good. It's a lot more aggressive. I'm basically using here a decreasing pip step, which is giving me huge trade volume, which has worked to bank a lot. But at the minute, I've got 15% drawdown and I've made 12.8. So this isn't ideal so far. However, when these open positions close and we get the reversal, which what goes up can keep going up, but it will come down at a point too. One would expect. I'm just going to see how that goes. I might choose to reset that and make some adjustments, but because of the risk engine on Darwin X, I'm not. They've lowered my risk, so I'm about break even on that account. It's got me as making like 3%, but 3% max drawdown due to the risk profile. So this variance here of being in 15% drawdown and $4,000 net equity loss, absolute drawdown so far isn't the reality. So I'm fine with that. Let's just see how it plays out, and I'm fine with leaving it running. Darwin X3, this one's on capital allocation. This is something else to share as well. So I did a bulk copy thing here, but that's now affected my multiplier risk engine. So because I was trading at 0.1 lot size, I initially had a multiplier on the risk engine because it felt like I was too low risk and it upped my risk. And then I opened some trades that were a lot bigger. And now it's sort of like confused. It's like, hey, shit, you're opening this and now you've opened that. Fuck, we need to lower your risk engine. So I've gone from like a multiplier of 3 to a multiplier of 0.22. So it's now only taking 22% of the risk of my 0.1. I don't plan on bulk copying and messing this up on that account now. So ultimately, what I'm banking here is far less on my Darwin X now. So I did message them and I said, right, how quick are you going to catch up to my new risk level? And it will catch up. I don't really know how quick. And it might be that I now increase the lot sizes on these sets a bit more. Yeah, I might look to do that. Yeah, just one to be aware of. Try and stay consistent-ish, otherwise you might get it might be difficult to understand what rate Darwin X are copying your account from. Gold long-term fixed account. I've shared this many times. Nothing open right now, as you can see. Now, this has had a couple of moments of drawdown, maybe 4 to 5K here and there, maybe 3-4 times in the last year. I'm going to talk about timing in a minute and the difference between prop trading and live capital, because I feel like there's a fundamental difference in trading both. Yeah. For both the prop firm and you as an individual. And this is why there's a lot of misconceptions over A-booking and all this stuff, because people don't really understand. So I'm just going to try and show you some context behind that. But this is largely consistent. You see nothing open. Closed trades, they're all fixed at 0.3. Good for 2 to 3% a month. But there might be the odd month over the period of a quarter or whatever, where there might be, if this was copying to a prop account, I might have to take a 4% hit and bulk copy the next day if that opportunity presents itself. But when you look at consistency as a whole, you would look to leverage this account to a point as well, or even reduce the risk and add it into other stuff. But I've got clear context. I've got clear understanding of this approach. Some of the trades are similar to what this takes, because this is based on a bit of a trending move, but on the lower time frame, whereas this has extra confluences. Okay. So this is the one this is where the POW score first originated. This was the first set I chose based on using ChatGPT to review data, come up with some calculations, blah 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 blah. This was the set that found, and then the POW score in Portfolio Builder was born. So if I flip to 2023, 5% really consistent, another 5%. And when gold is at a point where there's no real clear direction, and on the 4-hour time frame, that can happen. And because it's 4-hour, it's over a longer period of time. There are times where, like last month and obviously early days this month so far, but your trade volume is going to be could be lower. 0.5 fixed lot, no martingale on this, no martingale on that. And yeah, we'll just continue to keep this running because there's no reason not, based on this amount of data that I've seen so far. So again, back to choices when you're running sets. No right, wrong. What's the data telling you? Is it something that you like? Is it, it's low lot sizes. I know I can absorb quite a big move. I like the confluences in the entries. And there's some other stuff that I'm going to share on these accounts where I don't like some stuff. And some accounts that I've built that have not worked. It happens to me as well, right? And I guess what I'm reflecting upon and trying to help people like in the chats is to work out, are there any clues there? Are there more clues than what we're sometimes missing from what works and what doesn't? And if we can make that more robust, that might then help us filter our optimizations and make more decisions on them to do more of what works and remove more of what doesn't. And that might be things like, really small pip steps or PSEs, or how the multiplier works when we get to, I'm going to touch on that as well, Portfolio Builder. your ratio from lot size to max lots. I don't know, those sorts of things. I like to try and make sure I've made enough decisions around my optimization so it's not too crazy. So maybe the scope to make a few more. Maybe the max orders might be 1, 2, not necessarily to go from, down to 1. But by lowering max orders, you're basically telling the EA to find more accurate entries as best as possible. So that might be something to contemplate too. This is the longest account running, and not all of them are going to be as long as this because we've made various substantial improvements to Banker along the way, right? So this is just one by default that was running when we didn't have a lot of the stuff we have now. This includes some delay. Could this be better? Yeah. Have I got a lot of data on this? Does that give me a level of confidence too? Of course. And this comes back to this rate adjusted return. So if I go to a whiteboard, if it loads. Well, that's annoying, isn't it? Sorry about that. I was on mute. We're going to learn a bit of Zoom. Let's go back to my whiteboard, but it's probably not there anymore. Oh, here we go. So let me just go back over this. I was basically saying, because you would have, unless you're a good lip reader, it's not about net profit. It's not about maximal drawdown. It's about the ratio of those two things and how you can use those accounts in various different ways. A 700% account net profit with 50% max drawdown, we could decrease this risk by 10. We could decrease it even further. And we're still going to get very sensible returns over a period of time, much greater than a stocks and shares ISA, for example, with still very little risk. But someone looking at this might go, hey, 50% drawdown's high. That's far too risky. Well, it's made 700%. So let's put some context behind that 50% drawdown because of what it's made. Likewise, Jay in the chats the other week shared an incredible MyFX book for one of his gold strategies that had made 28% over 12 months with just, I think it was a 2 to 3% maximal drawdown. Great results. But some people would have gone, yeah, but that's 28% net profit. That's shit. Well, it's not because it's only 2% drawdown. So let's look at the risk adjusted return, which is over 10. And if you wanted to increase the risk here, you could, and you'd be doubling or increasing the returns. So yeah, risk adjusted return is just going to be more important than net profit and drawdown in isolation. So sorry, I was on mute. I'm going to keep an eye on that moving forward. So yeah, here's the account, 700%, 693, 20% drawdown. And this is one of the accounts that's also feeding the copy trade here too. I've obviously got lots of data. I know on this account the maximum sequences I've seen per trade, which enable me to then I guess make decisions. How can I use that? So let's say we have a sequence that opens more than what a year and a half has here. I might then flick to driving the EA manually to hedge that position if that was to happen, for example. It might then tell me that maybe something's changed in how volatile that pair is. I don't know. But when you've got data and those decisions, it also enables you to become more rational. Let's say you have some drawdown and you've got 4 positions open, but historically you've had a maximum of 8. You're sort of like, hey, do you know what? I'm within that. I know what move I can absorb. I've got loads of room. It might make, because you've got more confidence. Yeah. Back to confidence equals data times time. It is no secret, any of that. Yeah. So I've got another account actually that's on my FX book, HNA2, this one. And this has had like 90% max drawdown on my FX book. So it's nowhere near as good and got risky early on, but it's still done 457%. So even with a risk adjusted return, it's not as good as approach 1. But I could still run this at 1/10 of the risk it is, and it would still be quite solid. So what else hasn't worked? So this is a portfolio I built. I did 2 at the same time. I did 1 majors and 1 minors. Okay. And what's quite interesting is this one went to shit ultimately. And this is just really nice. And there are some clues in here that I haven't looked deeper at yet, but I'm going to show you what I might look at. So this is a majors account. And at the minute, I've got a fucking huge amount of GU trades open. Yes, they're small lots, but this is just too many. What does it tell me? Entry criteria is not really on point. Yes, they're a small lot size, but when you add all these up, it's still quite a lot of a weight in the market. So maybe my optimization, as I said before, would benefit if I reduce the max open trades. Maybe this is a really low ATR and a really low pip step exponent too. But then I look at the closed trades, and I've also got some EU 8 lots trades that may have caused me to close. Oh, it was the yen. I don't like yen pairs. I just don't like, because the yen is fucked on so many different levels. Yen's a bit like the Swiss franc thing that happened years ago where the whole thing crashed. Yen is just a bit nuts. So I don't normally run it, but actually the reason we had the margin call and trades close was actually because of yen. Load of 4.5 lot size. So these lot sizes are just silly. They're just silly. 8 lots, 4 lots. They're just silly. So what mistake have I made? I haven't sanity checked that, number one. I was a bit blind with Portfolio Builder, just saving the set files without really understanding what that was running. So I think there's a lesson there that yes, Portfolio Builder is great, but this is too much risk exposure on this account. And that's just something to, and that if this was a live account or whatever, would have stressed me out at those lot sizes. So when we use the lot multiplier and stuff on Portfolio Builder, I guess just be aware of what your baseline is and what that multiplier might end up being, and what that then might mean. So something to consider might be turning that multiplier off and running your optimization just based on what you would be comfortable in running on that account size, because then you know that that's not going to get adjusted. So ultimately, what I'm trying to say here is it's okay running a back test over a period and having a maximal drawdown based on your optimization. But on these lot sizes, all it takes is a deviation, and a small deviation, to totally go rogue. So let me put some context to that. Let's say these 8-lot trades on EU are 8 lots, and I've got 4 of them open. That only takes 10, 20 pips deviation for you to be in the shit. If they were at 0.8 or 0.5, that's not the case at all. I can absorb way more deviation on how that set's performed and the movement in the market. Okay, so I think if you take anything away from this, it's just understanding, well, so far, risk-adjusted returns, but also the lot sizes, really having a look at those multipliers and that data. See if, what you've been running in the market has left you any clues with what might work for you and what might not, and what might be or better suited to your psychology as well. And this Miners Master is just lovely. It's trading pairs like Euro Pound, AUD CAD, and nothing open. The Euro Pound trades are a bit high at 1.7 odd lots. Oh, and the other thing, like on this account here, there's numerous sets, so there'll be stuff that did work. Yeah, there'll be some sets on here that I can review in the terminal and go, oh yeah, I don't want to, because if you eradicate the account, I've said this to Michael before, if you chuck that account in the bin, then you've wasted maybe some stuff that is good. And you're like, oh yeah, that one's rubbish, but that's performed really well. I'm going to run that in isolation on another account. Maybe, so you've taken one account and one account portfolio, you've removed the stuff, the bad ones, or the ones that haven't quite gone to plan, and you've pulled some nuggets from it. But you've got to take the time to just review some of that data first. And I'm going to come back to that in a minute as well. So this account, Enter DCHF AUD CAD, has been lovely and consistent too. So this is one of the dilemma ones on this risk-adjusted return, because I've got 5% drawdown. This has peaked at about 7 or 8. So my dilemma here is, if I ever use this account, it's not currently running on anything, but from a risk-adjusted return perspective, I've got better, because for what it's making versus what drawdown I have from time to time, I've got better. Yeah. So, and that's okay. Actually, it's Enter DCHF that this is in. So it's just a matter of understanding it. If this was a live account, it would be, I'd accept it more, but if it's a prop account, I'd accept it less. And that's due to the nature of prop drawdowns versus live. Yeah, those different things really. Okay, so back to prop trading versus live trading. Everyone's still with me. What do we got? Yeah. So let's say we've got a trader. Can everyone see this, by the way? Yeah, just give me a yes, please. Super. Thank you. Let's say you've got a live trader trading his own cash, 50K, whatever. Any profit, any loss is all his. Okay. Now, if you've got a prop trader on a 50K account, let's say, what can I try and describe this? Let's say this trader gets to 55K, makes a withdrawal. He's up 5K. Yeah. If this trader did the same, he would be plus 5K too. Now, let's say he gets payout. That's secured. Let's say they then have a period where they lose 10K. Yeah. This person would probably breach this account. Yeah. Now, if this trader was backed by a book, by the prop firm, obviously profit splits and everything else, this trader has actually cost them 5K because he made 5 and then lost 5, lost 10. Yeah. But actually, it's worse than that because of the, let's say, 80% profit split. So they've actually lost more money. But the trader is like, hey, I'm on 5K, happy days. This is why a lot of prop firms use trailing drawdown, or will start to. Definitely they do in futures. Because what this would do is, after this point, it would bring up the prop firm's risk to mean that this doesn't then happen. Yeah. So this is why this A-book fucking conversation that people come up with. Why don't they just A-book everybody? Well, A, because most people fucking lose. 2, you don't know who's going to win and who's going to lose because traders are largely inconsistent. They start doing one thing and then do another. They then lose their shit and revenge trade after a loss, maybe here, some. And the math just really needs trailing drawdown at times to A-book them. So this trader, he's a prop firm trader. He shares his payout certificate and goes, woohoo, you know, I've joined the minority of people that are profitable. That might have just been a week or a month. Who knows? But ultimately, they then lost and breached the account. However, they can repeat this process. They can buy again, pass another, and repeat this process. This trader up here, where have I gone? Who made 5K, then lost 10K. Well, he's now at 45K on this account. Yeah. So what I'm trying to say here is prop trading versus live trading is very different. And the A-book myth in this example means a profitable trader turns into a losing trader for the prop firm. And, you know, in this instance, they've not banked 5K, but this trader did here. So it's like you can look at people and think, oh, you know, they've made all this money prop trading. But actually, what's their performance over a longer period of time than just a week or a month? Yeah. You look at like Sam's recent videos with FTMO, that's 3 or 4 payouts, 3 or 4 account resets into VIP, into Pro. You know, that is brilliant. And FTMO, because he's on that radar for that, would look to back him, I'd have thought. But it'll become a period where there's a losing run. And if that was in you know, on a live account, this would be nicely in profit too. But I think it's just a matter of understanding, you know, you're liable for losses up here. Yeah. You're not down here. And how you then choose to set up your accounts and how you choose to, it's just an understanding. Yeah. You might be more aggressive here because they're not your losses. Whereas here, your risk might be different. Okay. Right, let me just check my, let me just close whiteboard. And check my notepad notes. Account reviews, what are review? Okay, so onto the, covered that. Onto the one trade thing. So at the time, I did share I did share the optimization files that I had used. Okay. And I will share them again. What I don't like to do is share stuff that I've not even tested myself or got any real data on. And everyone jumps on the bandwagon effect. And then, there's no real context to it. So I will add them to this Q&A chat. There's I think there was a ranging one and a trending one in terms of one trade leveraging different stop loss pips and take profit pips, and the accounts in loss. But again, let's analyze why and what and the detail behind it. Although it's bloody crashed again. Can you all see this screen or not? The terminal? Okay, let me close it and open it again. I'll come back to it. I'm just going to wait for that to catch up. Another thing, I'll come back to that. Just hold that thought. So when we're looking at one trade sets or red alert testing, you've got to understand the maximal drawdown, okay? Because it's different. It's different. It's not different, but you need to understand the number in a different way, okay? So when we're looking at banker EA stuff, that maximal drawdown would mean open drawdown at that particular time, because we're not taking the hard loss, yeah, in terms of how that's tested. Now, with a one trade strategy, much like red alert, it's consecutive losses. So let's say I ran a set file on red alert or banker, but one trade, and it had a 1 to 8 risk to reward. Yeah. But my max risk is 1%. It's 1,000 on a 100K account. Now, if I run a back test and it says maximal drawdown 7%, that's not 7,000 in loss. That could be it went into profit 7,000 and then came all the way back and then hit the loss. But the loss was only 1,000. Okay. And you can see this in the backtest report, especially like red alert. This is how you need to understand it. But you run the backtest report and you'll see minus 1,000, minus 1,000, minus 1,000 or whatever. And your maximal drawdown might be like 10%. Well, it's because of that. But even if you didn't have such a high RR, you're going to be looking at consecutive losses. So if you've got 3,000 or 4,000 maximal drawdown and you're only risking 1,000 per trade, then that's a consecutive loss that happened, which will happen. It's pure maths. But if you look at the statistical chance of that happening in your backtest, maybe it might have happened in one day, then you would have turned off and made sure you stayed compliant in prop firm rules, for example. So the point I'm trying to make here is you've got to understand that maximal drawdown figure. With banker, it might just be open at one time. That's why we try and keep our maximum open drawdown in line with the strategies and the risk and the daily drawdown profile that the prop firm or however you're trading and your own appetite might dictate. But with one trade type strategies with stop losses and like red alert or what I'm going to show you in a minute, you just have to understand that it's about consecutive losses or when something goes into profit and comes back. Okay. The last thing not the last thing, there's still more things. We've got FileCamp, and some of the feedback John's been getting is we've obviously got quite a few different systems. And when you go on here and you go on to download the set files, it sends you to FileCamp. Everything shortly will just be in here and it just downloads. So you won't need FileCamp at all. Okay. The other reminder is this competency framework. A lot of people probably don't look at it. They don't know it's there. And I would make sure over the next week you all look at this and you check in with yourself on if you're green or not. Okay. Now, we built this to make sure there's no ambiguity on what success looks like. Okay. Because what do you need to know? And what does that competency look like? It's really important. How do you know if you're doing a good job or not? Job description, are you ticking these things off? And this is no different. So if you look at this and you go, which one are you for each of these three pillars? So we've got understanding the automated strategies, building the portfolios, and your own mindset. If you look at this and you go, yep, I know this. Yeah, I know this. Oh no, I'm fucking shit at this. And I'd be a red here. Then you're not fully competent and you've got work to do in that particular area to go and get green. Long-term sustainable success is when you're green in all areas and you know everything in them areas. Well, you'll never know everything, but proficient. Yeah. And if you're, amber in any of these, then go and hunt out the bit of missing knowledge or experience that you need in that area to get yourself fully green again. So this sort of stuff takes a lot of time to build. And I think a lot of people are always chasing the shiny object. But this is the shit that will make a difference for you. The shiny object over there that might break from time to time, or the market might not like that strategy. This is the stuff that will enable you to respond, not react. It will enable you to employ proper critical thinking and rational decision making to understand why, what, how, what your next step is. Without any context and understanding of shit here, you are totally fucking winging it. And you might be that trader that makes that 5K payout from time to time, but you won't have long-term sustainable success like Sam with numerous, consecutive payouts like I've shown you in the masterclass. It won't be there. So just make sure you don't get too complacent, because another thing, people overestimate what they think they know and underestimate what they don't. We don't know what we don't know. There's always learning opportunities. We're always a student of the market. There's always new ideas, new concepts that might come to us. Yeah. So check in with where you're at on there. It's really important. Right. Let's try this VPS again. What I wanted to show you on here is I'm running, here we go. I think this is working now. Yeah. So we've actually got a running trade that's 2,000 in profit. If we wanted to, we could bank that, right? But I'm just leaving this to run. The account is down, but it's only down because of EU. So let's just take a look. I shared some of the graphs in the thread. If you search the one trade thread in Discord, it will give you some more context of that stuff. I'm conscious of time. I've not even got to questions yet. So this is the overall P&L, minus 2.8, but obviously we've got this running here. If this hits, this is a 5-to-1 trade, just over. So let's just have a look. So if we go to, some of you might think, why are all the lot sizes different? Well, they're different because I'm using, the balance is going up and down and I'm risking 1% per trade. The stop loss actually is based on a fixed pip step, so it's not because of ATR. But if I go to symbols and look at EU, you can see I've hit quite a lot of losses. One big trade, 1 to 5, but I'm 7K down overall on EU. If I removed the higher RR strategy and higher risk, which is these ones, I only need one and a bit, winners on that strategy. This might be one, who knows? So yeah, that is what it is. The stuff, there's 4 sets running. I don't think there's a UJ one. No, that's the Telegram connector I've got. So yeah, something for me to review there. But gold in isolation, lovely win rate. Try and see. Don't think it's entered anything today. Oh, I hate it when it does that. Here we go. Sell. these little trades on here that hopefully you can see. If you can't see them now, you'll see them on the replay. Yeah, here was a busy day. This is probably the ranging set, to be fair. Markets are probably a little bit more stagnated there. But yeah, so what am I going to do with this? Well, I'll probably pull these gold sets out and put them on a fresh account to build just gold data in this approach overall. Because if you were going to be looking at hedging prop accounts with the concept that I've shared, where we hedge it against live capital, you could use this. Yeah. You could double the risk on this. So you're trading 6 lots, you'd have made 8.5 grand, you'd have passed an 8%er with this approach. Yeah, you could actually probably even up the risk even more. Because if you take a loss or you fail, you've covered it anyway. And that would have meant you used banker and passed that in for 1, 2, 3, 4, 5 trading days. Yeah. So there's loads of opportunity and thoughts to unpick on that basis. But I will share the op files in here later for you to have a look at what decisions I made on that optimization to give you insights on what you might look to do with yours. Okay. Right. Stop. Share. Back to my notes. Are you competent? Being realistic. Oh, yeah. That's the point is having a plan and a vision and being realistic with it. I see a lot of people aiming for the stars and being unrealistic. It's probably naive positivity instead of cautious optimism. However, I believe there's like 2 levels of being realistic or not. There's one that where you might not achieve it because you've got no probably knowledge or experience or results to date to justify aiming so high. However, Will Smith's got a great quote: being realistic is the most commonly traveled road to mediocrity. I fucking love that quote, because who would have thought pressing a button and turning a light on was realistic? Who would have thought a fucking plane flying in the sky was realistic? It's not realistic. So it's okay to have big goals, but you've got to start somewhere. You know, building a plane didn't start with the fucking Boeing 747. It started with probably a very smaller concept, and they got proof of idea. Yet some traders I see think that they can go from 0 to fucking 7 figures in no time without seeing those small milestones along the way that are going to give them confidence and belief and knowledge in achieving that bigger goal. So ultimately, you've probably seen the picture. There's 2 ladders. There's one where you can't actually fucking reach the thing, and there's one with tiny steps. And I think people have to review their goal setting and go, okay, what am I missing? What might go wrong? What results have I had to date that might demonstrate that I'm on the right path? And am I on track? If I was to break that 12-month goal down into, 9 months, 6 months, 3 months, what would that look like? Yeah. How am I going to react if something goes wrong that is not in my control that might derail me from that? And that's, having realistic, cautious optimism, but a specific plan with it too. But then make the money mean something. So that first withdrawal on your live capital or prop account, it might be, I've paid for a meal out for the family this month. I've paid for my supermarket bill. Now I've covered the rent and the mortgage. Fuck, I've covered the mortgage for 3 months from my trading thing. Hey, partner, all this time and I'm fucking looking at all these graphs and shit. Hey, there's payback here. It's coming. And then you might increase again. But you can't go from fucking 0 to 40K a month. Yeah. So just reflect upon where you're at on that journey. I know the whole prop thing is very, a sore subject right now. I get it. It's really tough in numerous different ways. And, those of you that like the FCFF thing at the beginning, we all got caught with, making a load of profit on a funded account and not getting it. But you know that you can then. So I guess sometimes it's a matter of, let's keep perspective. This isn't life or death. it's frustrating, and there's lots of things that we can't control, including me, on what happened. But hey, look, you got that funded account, you made that amount of money. It's proof of concept that you can, which in turn can build confidence for you to go and take that skill and go and continue to do it with other firms or on your own live capital too. Yeah. My last couple of things. There's a time to be risk on. There's a time to be risk off. You know, and I saw Fred the other day, 20,000 US dollars gold on FTMO. Fucking brilliant, right? Absolutely brilliant. And but you know, there'll be times to that withdrawal, you could put that into a trading account, but you might not put all of it in, you know. So at what point are you risk off on some stuff? It might be you buy property. It might be you open a stocks and shares ISA, which you can put 20,000 in a year in the UK and not pay tax on profits. So you've got to look at, you can't always be risk on with everything all the time, because you will get humbled at some point and be too risk orientated. So know what to risk and know when to protect some shit. Yeah, really important. Right, I've covered that. I've covered that. Right, this last idea, and then I'll get into questions and then summary at the end. Live trading, just a bit of a concept I saw from somebody. I can't remember where I saw it, but they basically put 1,000 into a trading account every Monday, and they traded really aggressively. But they knew that the worst case scenario is they've lost that grand. Now that grand can be relative to wherever you're at, but that might work better instead of, say, him putting in 10 grand, and instead of risking a grand, he's got his whole account exposed, which might lead to poor decision making. If he loses that a grand on Wednesday, he can't start again until Monday. But most times you can end the week in profit, withdraw the profit, and go again the next week. Now you could start this with like $200, $100, $50. You start with anything because you could transfer it to a cent account and follow the same principle. That might mean you look at very aggressive banker portfolios over a short period of time. And, you know, if you start with 1,000 and make $400 in a week, you could do that. For sure you could. Withdraw the 400 and the thousands reset for the next week. Do it again. Make a bit more, make a bit less. There'll be the odd week where you blow the grand. But that's probably better for some people than having 10, 15 grand into a trading account, and internally they might lack the discipline to take that loss. So it might be something that I'm thinking I'm gonna start that and document that process of each week. This is what I did. This is the risk I had. I mean, look at the copy trader with the 0.01 trades that we've had. There will be a period where we get stuck in a bigger sequence and a little bit more drawdown. But hey, if I had have upped the risk, and a load of you have been asking about upping the risk on it, I'm not going to do that. If you want to do that, you can, and it's your own risk. But if I'd done that on this process, that account could have been substantially up. You know, I'm talking 40, 50% a week, but there will be the odd week where it catches a cold. And Michael's got a similar thing that he'll probably share on his next Q&A with what he's looking at too. So it's just a matter of, okay, what can I play around with weekly aggressively or not? And, you know, that's definitely a risk on thing versus a risk off. But you wouldn't put your last pound in this approach. That would be silly. But you could try this with $50, put it into a cent, which would be, you know, more tradable, and do the same thing. Okay, right, on to questions now. Sorry I'm ranting on, but I hope some of it's useful. If it's not, I apologize for your wasted time. Right, I'm going into Discord now. Here we go. So on to the questions. Shall I screen share for the questions bit? Just so you can see what I'm on with. Thanks, Christian. So all I'm going to do, I won't screen share because I don't think I need to. But if you go into Discord, go onto the thread. I'm going to start at the top. So Will, 2-year back test, 6 months, some of the sets have performed well. So yeah, I've covered some of that today. I think there'll be, if you like the set and it's performed well, I see no harm in you either pulling it from that account and keeping it running on another demo and building that history of that set in isolation, knowing that it's done well for you so far. Or you just keep observing, it opens a new max trade sequence, or it hits you a new drawdown level. Obviously, some of the accounts I've shared have got sets that have run there for a long period of time, and they've outlived the optimization walk forward concept that I share. And that's just to try and keep people on the right track and keep it relevant. But hey, I guess if you like it and it's running well, I see no harm in keeping it running as long as you're aware, keep observing it, making sure it's in line with what it's done so far, or accept the fact that if something, if there's a freak move and something happens, it still doesn't mean that that's then a bad set. Much like, a trader, that $5 prop trader doesn't make him a good trader, because he might not be able to trade for shit really versus long term in the market, in the live market. Likewise, a trader who loses a funded account or is in loss for a week or a month doesn't make him a bad trader, because he's probably got a longer term track record than the other one. And sets are the same. You just got to understand, was that move really freak? Was it that NFP? Was I in that? Whatever. Critical thinking will always be the game. So short answer is no right or wrong, but if it's doing well, there's no harm in keeping it running either. NK7 MACD. Well, we've had other priorities over the like the news stuff and weekend closing stuff, which we've gone under. I do plan on going through the ideas channel again next week. I know you've been badgering about it. My gut instinct tells me we don't need any more mechanical indicators, but let's tick it off. Let's get it checked. Like the EMA thing, there was the idea over the triple amalgamated EMA. We tested it, didn't work better. The results were a mixture. There was nothing concrete that suggested we should add that as another thing, as another optimization to confuse more people and to just make it more difficult. If anything, I'd love to remove stuff. Yeah, so I might do a vote on that. How many of you use Accelerate Recovery? Probably not many. I don't. So sometimes the magic is in the removal, not in the adding. Hence what I was saying at the beginning about optimizations working or not. There's clues in what's working and there's clues in what's not. And I think maybe we're missing that right now. So I will get to it, bear with. Op files for single trades, I will share them here. Maurice, yes, so the Fast Genetic 10,496 is all covered in the MQL5 support help guides. That's why we prefer Fast Genetic too, because each time you run it, there's a deviation in results. Still good, but it helps keep everybody unique by default too. All it does is making decisions on a genetic algorithmic test. So if it takes two values, which one's better? Or that one's better. Two values, or that one's better. And it might recheck against that one. So it's doing a sophisticated test. Ultimately, and that's why we can be quite wide with our optimization, and trust that Fast Genetic is going to do a job to find us good results. Can we cover where the op files are saved when loading into MT5? How do you load it? So I've covered this on the optimization, how to adjust optimization files in the app. So whenever there's a video and stuff's valid, I will download it, edit it, maybe speed it up a little, and add it into the web app. So the optimization file one based around lot size consistency, how to adjust op files is in your web app. Okay. Ultimately, make sure you're on Fast Genetic, go into the inputs, click load the optimization, change whatever you want to change. So it might be max trades 2 if you were trading and not wanting to be grid trading. And then you just resave it with the adjusted version. There's the short version, but I do that on that video. Elton FX, Algo Forex Funds. I think with the greatest respect, that is a huge red flag. Their rules, their pricing, their Trustpilot, their website, And sometimes it's like, just be careful, the whole reason I left back in April was because HFT needed to be turned off. Others didn't agree. As I've tried to allude to before, I was banging that drum from mid-March. So although it looks like I left and it went to shit a month after, I was banging that drum fucking daily for weeks. And you look at their model and their drawdown and their profit target, it looks like the biggest fucking money grab ever. To not ever pay anybody for sure, I would doubt. So just have a look at it, because it doesn't look legit to me. So on to the next one. But if you do, and yeah, keep an eye on it, but I would be absolutely fucking amazed. Okay. Oh, Dustin, you responded to that one. Thank you. A rogue set. What causes it? What causes it? What causes it is the fact that perfection doesn't exist and no backtest is ever going to be perfect and cover the future. Markets change, hence we try and keep with the moving markets. Economy, COVID, Brexit are all things that change, and there's always a new thing. Yeah. So, also you might run an optimization with high martingale, that close stack of sequences in news by 1 or 2 pips, and there are some outliers to your optimizations that might make them less valid in how they run in the live market. For example, if you didn't trade, the news section to a point, or if you close trades or managed sequences, if you didn't run martingale, if you used all the technical indicators or as many confluences as possible, you are increasing your chance of seeing that play out versus the opposite to that. It's just understanding. It's also having the expectation that, hey, this is about preparation and doing work, but it's not going to play out all the time. I can show you loads of accounts where it has, and I can show you some accounts where it hasn't. But there's some learnings in the ones that have, and there's some learnings in the ones that haven't. And we can navigate that as best as possible. Ultimately, the only controllable thing that you decide to do in trading is the amount that you're willing to risk in any way, shape, or form. That's your only certainty. There is no other certainty. You can build lovely diversified portfolios. But if you keep, I think the lesson here is if you're always keeping max lot size and lot sizes in line, and you're aware of the trade volumes of your set, it would take a lot for something to go rogue. Because let's say we started a 100K account right now, and we just chose sets that were sub 0.05 lot size fixed across 5 or 6 different portfolios or strategies. I'm pretty sure you would not see a drawdown on that account of above 2 or 3%, like fucking ever. Would it make 1% a month? Who knows? Would it, could it make, it might make 1%, and over 12 months, you've got a 12% return and a 2% max drawdown, really nice risk adjusted return, like I covered earlier. I gave Goster this advice in the quite a few months ago, which is, trying to run low risk, smooth sets for live capital or funded accounts. And so there's a lot size thing. Because if you're trading one lot or 0.01, I can cover a fucking shitstorm on 0.01. And the chances of there being a shitstorm are probably low in isolation. But things will happen from time to time. And when it does, hey, we can still weather that storm. On one lot, you can't weather the storm, especially on a prop account. And on live capital, you might be able to weather the storm over here, but it might cause you a fuckload of stress or higher drawdown on live money that you don't want to risk. So I think understanding what causes it, it's the accepting that perfection doesn't exist, how to prevent it, fixed lot sets, lower lot sizes, stuff like that are going to help. And when it does happen, review maybe why. Like that bit from earlier, made the majors account, the minors account. That's probably the best example in real life context of answering your question. And if you hit an EP on a prop account, I've covered this in the advanced training video, you can bulk copy that account the next day and increase your recovery factor of that account. Now, ultimately, if you hit 4% loss, it's going to take you longer to recover than a 1% loss. And the other factors here is your rate at which you were making profit anyway. Some traders try and play too safe, but then hit their loss anyway. And some traders might look to make more, knowing they're going to take more losses, but they can recover more quickly. There's no right or wrong to that. It's just understanding the math behind your portfolios. Yeah. Good. Hope that helps. I know it's mentioned in videos, but a recap onto Richard's question, diversified masters single trade. I know it's mentioned in videos, but a recap update would help. Ideas for diversified masters against trend range, Asian single trade. What else would you recommend? Oh, okay. I get you now. So I don't see any harm in running just a trend portfolio, a set of trend strategies, a set of another portfolio with ranging strategies. And then you can just see how that looks and goes. A portfolio with, one trade, lower strategies, custom times too. Yeah, a lot of that. Now we've got that option. You can optimize that anyway and see what clues come up with. Like your trend strategy might say yes to US. Your range strategy might say yes to Asian by default. So that's not necessarily a choice anymore. Well, it's a choice, but it's not a decision you make. It's a data-driven decision. And then you can look at a batch of minors and major pairs with 2 or 3 strategies per thing. So I would say that as a minimum, really, and then you start exploring the one trade type thing. But there's loads of diversification within that. There's 28 pairs. I don't run any indices stuff just because of the contract size shenanigans. But yeah, majors, minors, diversification within the account, or a trend portfolio, a range portfolio. You can then also take it further. You could run one really small without a global EP, or one long-term test, short-term test. I know some of you prefer the short-term test, but with a risk per set and per strategy that is deployed, maybe $500 or 1% on a 100K account, because it recovers more quickly. There's that too. A bit more work involved in that. The amount of times that you have to refresh them sets, for example. So yeah, hopefully that helps. Op files, I will share it, Graham. HFT prop firms currently. Not currently. No, the one that I was considering was optimal, but it looks like you can't actually even, they say it's a HFT passing thing, but none of the HFTEAs seem to work. My Western Pips terminal, they're just useless. Western Pips are. So I've not looked at that anymore. But if anyone's with Optimal, let me know. They seem to have sensible rules over the HFT thing. And they've capped the allocation, which I like too. But other than that, no. I've been prioritizing live capital over this time and leveraging the accounts that I'm already running to do that with in various different risk profiles, really. Oh yeah, thanks, Richard. Good stuff, mate. So yeah, that's that really. I think ultimately my tips for HFT stuff is see it as a risk to reward from a trade perspective. It's like you start having a trade. If you do a 100K account, it's like you've put $500 into a trading account and you're going to trade it aggressively and it might lose. And you might lose that $500. But if you can make $500 and pull your money back out, then you've got a free trading account. That's how you have to look at this. Yeah. And I think you have to look at it like that with prop firms in general. What really frustrates me is this HFT thing is one thing in isolation, but the firms that are no longer here, that have screwed people over, more are the ones that have just run into the sunset. Angelo, we've not seen his face for I don't know how long. And they're standard models, non-HFT, TFT, SFT, TFF with his Lamborghini, all that stuff, standard models, not managing cash flow, or, maybe they need profit caps. Nothing wrong with a profit cap on a prop firm account, in my opinion, at a sensible 5%. That's $5,000 on a 100K that costs you $500 to get it. I don't see an issue in that. Same with, 200K account. It would be 10 grand. I don't see an issue in, maybe that's the sort of change that might come in at some point. But hey, a year ago we had FTMO, myforexfunds, TFT, and True Forex funds, and they were the top four that we were looking at hedging between each other and being a bit smart. And only one of them exists anymore, which you would never have thought that 12 months ago. So I think, hey, yeah, you'd always bet that FTMO are as safe as any of them. But what you don't know is what's their balance sheet like versus what it was. Are they dipping into reserves? Is there a different trajectory? They've diversified into other things, which is great. They've got the quant lane hedge fund thing. But their rules on that, when you get that opportunity, mean you can never trade an FTMO challenge ever again. And the rules, and you literally have got a desk. And this is the other thing with prop firms that fascinate me. Traders want to be A-booked, want to feel secure in their payout. They want to feel like that's in the live market. But yet they don't want the rules. And then when rules change, it's like they're a scam. But fuck me, if you worked at a hedge fund in the city, any decision you make would have been overseen by somebody else. I want to enter this trade. Okay, fine. But why? You know, this is what's your risk going to be? Okay, you know, or whatever. Depends on their allowable rules. But let's say you have a losing week or you get scrutinized. The next week, your boss man or the risk manager might say, hey, Darren, last week you lost 2% of the market. This week, I don't want you trading over news and I don't want your risk to be any more than 0.3%. Now, in prop firm world, at 80% fucking payout, that trader's going, fucking scam. But in the real world, that hedge fund trader is like, yeah, okay, boss. Otherwise, I'll lose me fucking job. So it's very different. Yet that hedge fund trader is probably on 15, or the whole hedge fund might be only taking 20, 25% performance fee. Yet the retail prop trader's on 80 or 90%. The whole thing's mental. So I think it's just people need to understand that A-book example I gave earlier. They need to understand the perspective over, do you want a desk in a city where someone else is overseeing those decisions or not, or giving you what you can and what you can't do versus an 80% profit split on simulated capital? You know, it's like, hey, it's crazy, really. Anyway, sorry. Chris Maria, set processor doesn't make the set files or graphs. I'll pick this up with Chris. I've never heard it open random apps before. Fucking Netflix and shit. I've never heard anybody say that. So I would wonder if maybe your terminal isn't full screen or it's minimized in the middle or something, because ultimately what set processor is doing is mimicking a mouse and moving the mouse into a specific place and doing the shit that you would do as a human. But if your screen resolution or if you've got different screens open, that's why that's happening. So I would make sure your MT5 is full screen and you just fucking leave it and then let it do its automated thing. Okay. What do we got next? Optimizing up to a few weeks, live simulation. That is found more reliable set files this way. Gostra Mini Nova, yeah. Yeah, I agree. So ultimately, some have said they do that. It's no different to the walk forward phase. In terms of mechanics, the walk forward is testing something on fresh data that hasn't been optimized, and all that is there is the same thing. So yes, you could do half, but you could also just like, if we were running a back test right now, what are we, 6th of June? Let's say you did a 12-month back test. You could run your optimization and walk forward bit. Well, so your optimization, the testing dates, you could run them up until mid-March. And then it would be optimizing, for example, from like, let's say you did January to now, last year. So 16 months, for example. You did that test with a 1 to 3 forward. It would probably do the optimization from January last year to maybe November time, and then walk forward December until like May or now. Or just, you could just pull it back 2 weeks if that's what you wanted to do. And because we've got the set processor now, when it downloads everything, you'll just see if that last week or two has changed on anything else and make a decision based on that. But ultimately, you could increase the walk forward period too. And what that will do is give you more statistical significance in the walk forward phase anyway. But you could explore both. There's no right or wrong with it. I don't think it hurts, but I also don't think there's a massive upside to it personally. But if it helps someone feel like they've done a little bit of an extra thing and it's more valid for them and that gives them more confidence in what they run, and they've seen better results, whether if, can that be proven? This could also be a phantom thing, right? Because they've added that process. Have they done a direct comparison of yes and no? The choices that they would have made. I don't know. Ultimately, do what works for you. You could increase the walk forward, or you can just keep, like in that example, you could run your optimization until mid-March, run everything, and basically you've got the last 2 weeks, end of May, sorry, to beginning of June, that isn't in optimization or walk forward. It's just how did it continue, and make the same decisions. We're near the end now. I know this is a long one. I apologize. Hard breached IP address only funds. Yeah, fuck knows is the reality. I think it could be social trader tools. But when I was involved, at least because PTT would have flagged loads of people at the time, and we were like, no, they're just using social trader tools. We had everyone's IP addresses from those providers, and we're like, hey, no, it's that, or no, it's that. It's fine, and intervened. Fortunately, when you keep intervening on a model that doesn't actually stack if you do it legitimately, then you very, very quickly they run out of cash. So that's the reality of a model that isn't sustainable, right? But you don't know it's sustainable until you try and do things legitimately based on that. I'll get sued soon. So is it down to the VPS thing? I just think it's random, personally. How would I navigate it to make sure run a Traders Connect dedicated environment and don't log into any more than one, or if you use a VPS and you use FX Blue, that might even be more robust. If you have a VPS, your own VPS, and you only log in to your account on that VPS, including your fucking dashboard, then it's like, hey, I've not logged in anywhere else, not walking out, not anywhere. It's just, and all you do is log into that VPS. That will help. But ultimately, I think if you've got a big payout, it's an easy breach for you. It's sunny outside. Let's breach you. So again, like I said earlier, your payouts should be low. They should be sensible. Get your account risk-free. So you put that 500 in and you've double, and then you need to try and detach emotion from the outcome. It's like I saw Michael shed it earlier. I didn't see it earlier, but threatening people and shit. Let's put some perspective on it. But let's also accept, pushing for 9, 15, 20 grand. The outcome's going to be really clear, I think. So try and get that first profit split to be in relation to your account fee that you paid to start with. Wouldn't overthink the IP. If it's not, it's bullshit, copy trade, £500. Yeah, that's it, Richard. I'm afraid that's the reality. And yeah, you can look at this whole HFT thing or PTT thing. What's the perspective here as well that we can all get emotional and we can look at it rationally too. So there's a load of people who might have earned that have been breached illegitimately, and not got the account. There's also a load of you that have earned a lot of money, and me personally, from the good time before it turned sour, probably beginning of the year, February, March. And maybe traders just got better. Yeah. New rules. I definitely know for the POW lot, we navigate them. There's always a way around things. And maybe the whole marketplace, maybe people are just improving in their abilities overall. And that could be the same year on year, because if you look at trading as an industry and as a whole, there's more 18-year-olds trading than the older people who are what I mean, how can I word that? The demographic is continually growing, which means those that have been doing it for 2 or 3 years invariably get better. It's an interesting shift in the retail market, maybe, or maybe I'm overthinking it. But if that opportunity hadn't have been there's a load of people like me, like Goster, like some of you, that wouldn't have had that opportunity at all. So it's like, hey, we can moan, kick off, and yes, it's bang out of order. But if it doesn't exist at all, it's not there. It exists in a form that is flawed, but we also did earn X amount from it too. And that's the same with prop firms as a whole. Everyone can moan, everyone can over rules. And Twitter is fucking horrible. I'm not on there watching because it's fucking awful. Like SA funding pips or a new firm or whatever, or E8, their one-step plan actually looks sensible. It's got profit caps and risk caps and whatever. The whole fucking bomb goes off. How shit it is, how much of a scam it is, no one's going to buy it. It's like, well, hang on, do you want the prop firm model to exist in a form? Even if it's not as good as it was, the choices are it doesn't exist at all, or you have to fucking compromise. And I think we have to sometimes leave emotion to the side as best as we can. We're human emotional beings, but let's look at some perspective here over, look, if I want it to exist, there has to be compromises over there with what that looks like. Or it doesn't exist at all. If it doesn't exist at all, what else are you going to fucking do? You're going to be the trader with the live capital who's just taken that 10,000 loss, but on your prop account, you didn't. And the timing of those different things enabled the prop trader to get a 5K payout. On your live cash, that didn't happen. So I think we just have to be aware of that. Yeah. And, take all of it in and gain some clarity with it. Yeah. I'm not saying anything's right, wrong. I'm saying you've got to take the good with the bad sometimes to a point. Yeah. Right. Yeah. So I'd navigate that with your dedicated VPS, use FX Blue, only log in there, or use a dedicated environment. But then where do you log into your dashboard? You're going to have two IPs. You're going to have their IP and the IP that you've logged into your dashboard. And then you've probably got your phone. You probably logged into your account. Oh, my phone's fucking here, isn't it? Then you've got three. Just something to consider. The only way you beat that altogether is your own VPS. fxvps.pro, $15. FX Blue Copier, free on whatever accounts you've got there. Then you could basically go, hey, that's impossible. I've not logged in anywhere. This is my own VPS. I've not even logged in on my phone. I've not even logged into my dashboard anywhere else. And just see what comes back. Someone, White, sorry, first names, it's Discord usernames, isn't it? Shared one of their breaches. It wasn't even an IP address. It was a long fucking set of numbers and letters. It's like, well, that's not an IP address. So we sent him back to email back to say that. But yeah, they can breach you for one thing or the other. How do members old subscription get access to red alert? So two things. I will look at something because there's a load of you that A, have asked, and B, there's nothing really valid for that. So I will review an option for red alert, maybe 3 licenses. I don't know. I think 5 might be too many, and 1's probably not enough. So maybe 3 is the magic number. That's an IP address, mobile data users link. Okay. But yeah, it's sort of like it removes all of that if you're not logging in anywhere. Tom, I guess, doesn't it? And then you've got POW Edge. So I've tried to make this as robust as possible. I'm not going to share it now. I'm conscious of everybody's time. I'll cover it another day. 1-to-1 R, using all banker style stuff in TradingView. 5-minute chart gives enough trade volume, but only trading between 12 and 4 UK time, which is US market. Last week would have been 12% return based on 1% risk. This week's in a loss. I can go back further. And that's without discretion. So there are many times where you could scale in stop loss to break even, all of that shit. But I'm trying to give it as mechanical as possible. So I've automated it. I've tried to remove too much tweaking and fucking about by saying, hey, these are mechanical inputs that work across all of these pairs without you having to change anything on these time frames. And if you're sensible with your risk, they're like 65, 75 win rates on 1-to-1R. The reason I choose 1-to-1R because I think it's psychologically in line with most people. Most people trading ICT, SMC bullshit can't handle the losing runs based on how tight stop losses are. And the math of probability of that means you could lose 10, 15 trades on the bounce, and then your head's gone and you're wondering if you're doing it right. So there's a balance there. But like last week in isolation demonstrates what could be possible. Trading view is not perfect. I've always been very open with that, with mid price, with the lack of functionality and being able to test efficiently. But there are some new Chrome extensions out that might help with that. But I've tried to come up with inputs that you shouldn't really need to change and still get a result. And if you're a manual trader or someone who does both, then that might be something to consider too. So I need a bit more testing with it. Maybe this time next week I'll be in a position just to add those strategies to people that joined from October or had Edge before, and then a non-expensive deal to get it added if you want it. So that's it really. An hour and a half. Sorry, it's a long one. I make a list of things that are often worth talking about and sharing. If anyone wants to put their hand up with anything right now and ask something right now, then you can. There's only 8 of you left. If there isn't, I'm going to depart and let you go. But if there is, raise your hand in the next 10 seconds. As I said earlier, this will be downloaded. It will be uploaded to YouTube. Just give us a bit of time to do that. I'll assume not. No worries. Thanks, Richard. Thanks, Clara. And thanks, Tom. Good news. I'll leave you be. And yeah, catch you soon. Thanks, everybody. See you later.